7x growth in 3 years is not normal.
Yeah.
Especially when you're dealing with highly customized, specialized products and low volumes.
If you're focusing on multiple SKUs, you delivered one stand, for example, right? You found it extremely good, useful. You've entered the customer, you've broken through. There are multiple things to sell.
Correct.
One single aircraft has millions of parts.
Right.
These guys can get somewhere through higher SKUs as well.
Right.
So if they show capability of producing something well, more manufacturing work will come their way eventually.
This episode of Taking Stock is brought to you by Paterson. Hello and welcome to another episode of Taking Stock. We are a weekly podcast where every week we talk about one company, one stock and dive deep into it. Today we're talking about this company called Unimech, right? And they've got a very, very fascinating story right here in Bangalore. Unimech's grown by 7x in the last 3 years, right? And they've got a goal of reaching 1,000 crores in revenue by 2029. So we're talking about a company that's not even a decade old. They've just IPO'd last year. Last year?
Last year.
Yeah, 2025 IPO'd. And they're going to hit 100 crores in 2029. Or they're 1,000 crores in 2029.
Yeah.
So what drugs are they selling? Is this Breaking Bad?
They're actually in a very boring business if you have to look at it. It's one of those things where you try to dig deeper and you feel like all these terms, it's the reason why you didn't do engineering.
That's a saying, right? That the more boring the industry you're in, the less competition and more money there is to make.
Yeah, boring businesses make money.
Yeah.
That's the whole, that's in front of us right now. But surprisingly, while all this has happened, the stock has gone from $1,500 to $800 after IPO.
So the stock's gone down.
So you're not even making money.
Yeah, so the stock's gone pretty much half.
Yeah.
But the company's kept on growing.
Yeah, for the last 6 months, they've sort of been flattish. Their revenue would have grown by 4%.
Right.
But hey, the market is used to much more. So 4% is definitely not satisfying the markets and hence the stock is down.
This is a statement that I'm reading over here in an article, right? That they've said they've got a goal of reaching 1,000 crore revenue by 2029. No, anybody can have any goal.
Yeah.
But they're also on track to achieving this.
Except for the last 6 months. That's what. So I think the one factor that has hit them massively is the US tariffs.
Right, of course.
One man screwing up a lot of things for a lot of people. So if I sort of just have to see, the thing is, at the end of it, India has been slapped with like a 50% tariff.
Correct.
Right? Now you're talking about, say, for example, they're selling a product which is like $100,000. Right? Earlier, they were paying a 5% duty.
Okay.
So it would turn out to be $105,000.
Right.
Now, for example, 50%, they have to shell out 150.
Correct.
So the way tariffs work is that they'll ship the goods from here. It'll cost you, say, whatever, put a random number of $5,000 to ship it.
Right.
It goes there and the landed cost is $155,000. Now, who's going to absorb the cost? Right. The duty is a duty that the customer has to pay once the goods have landed.
Correct.
So now the customer is going to be like, hey, Unimech, either you reduce your price or the buyer is actually...
But it's the customer's president who slapped the tariff, essentially, right?
Yeah, but then it puts things in a limbo, right? Because what's essentially right now happening is that people are... Earlier, they used to buy these products and also keep them in inventory, right? Because I'll always have 3-4 of these machines, for example, in spare, or I'm going to keep them inventory-wise. Or I need them 2 months later, but I've still ordered it right now.
Fair enough.
Now, customers are sort of... Because there's so much... confusion around who will pay, who will take the hit, what happens, etc. Companies are sort of ordering only when absolutely necessary.
Okay.
They're like, hey, if we need it, we're going to take it because we have to pay like 50% duties on it.
So Indian companies are sitting on sort of unsold inventory a lot more than they were before.
Yeah, and what happens is in a product like Unimech, where they're in... which brings us to the business.
Right, yeah. What does Unimech do?
So they make complex sort of parts, products, which take a lot of time to also build because these are customized products.
So these are airplane parts, essentially,
So let's put it simply. They're present in sort of 4 industries.
Okay.
They're present in aerospace, defense, energy and semiconductors.
Okay.
These are the 4 spaces they're present in. Now, primarily, they're making a few things. One is they're making a majority of the revenue comes from something known as the tooling.
Okay.
Then they're making mechanical products. They're making electromechanical systems. And then they're making precision components.
Okay.
So very boring sounding things.
Right.
Majority of it is tooling. Now, tooling is not something which actually goes in the aircraft or the aircraft's engine.
Okay.
It is critical in that makes it possible to manufacture, assemble, and repair an aircraft.
Okay.
So
fair enough.
Basically, then these tools can be used for aero engines. They can be used for the airframe itself.
Right.
Or they can be used for ground support.
So essentially, their customers are companies like a Boeing, etc.
Yeah. So primary customers for them include Boeing, Collins Aerospace, Airbus, GE, Rolls-Royce, Dassault Aviation, Mitsubishi.
Fair enough.
So anybody who's either making an engine or making an aircraft
Understood.
will be the primary customer for these guys.
Understood.
What these products typically will be something known as a low volume, high mix.
Okay.
So high mix is essentially high engineering components, high complexity, and because it's high complexity and specialized, the volume is low.
Understood.
So they specialize in making highly complex products, but at a low volume.
Right.
So just to for example, give you majority of the revenue comes from aerospace.
Right.
And a majority of it comes from tooling. Right. So just to highlight or make this a little more practical or real, I'll probably just give you an example of what they do. So there is something known as a LEAP engine.
LEAP engine.
Yeah.
Okay.
So a LEAP engine is a aircraft engine.
Right.
It's called a leading edge aviation propulsion engine.
Okay.
LEAP engine. It's co-designed by GE and Safran.
Okay.
These two companies have come together to design this engine. Now this engine has three variants. One is used in an Airbus A320. One is used in a Boeing 737 MAX. And one is used in a Comac, which is a Chinese aircraft. They don't buy Boeings and shit. They buy, they build. Yeah.
But I'm assuming these are the three most popular sort of aircrafts manufactured in the world.
Yeah, these are most of the. There is narrow body and wide body. These are the narrow body aircrafts, which are your smaller. You see your Indigo planes.
Correct.
These are primarily standard size plane. Now, these engines have replaced the previous generation of engines. Right. So when you say, for example, Airbus A320 Neo, you would have heard. Neo is new engine option.
Okay.
The previous one was a current engine option. It's called a CEO.
Understood.
So now it's replaced by a Neo. And these engines are primarily here, produced by these guys, GE and Safran. Now these engines are replacing the older ones because they are 15% lower emissions, lesser noise, more mileage, stuff like that. Now, these engines they cost some $15 million upwards, right? A single engine, and you've got two in an aircraft. Now, these engines are not, imagine you have to lift an engine, transport it, fix it in the aircraft, check for vibrations, check for whatever, right? There's a ton of things to do.
Yeah, and you can't go wrong with it. There's lives at stake here.
Yeah. So you can't go wrong in that. And these are highly critical parts. So Unimech now makes a stand for these engines to sit on.
Okay, while the testing and installation, while the things are happening.
So look at it this way. The engine is first made in the manufacturers. See, engine manufacturer and aircraft manufacturers are two separate companies.
Correct.
Boeing, Airbus are not manufacturing their own engines.
It's usually Rolls-Royce.
Or GE or whatever.
Right.
So imagine this engine is getting built in GE. So GE requires a stand while building. Then they'll transport it to the aircraft assembly, where all the parts come together and a Boeing or an Airbus will actually put the engine in.
Correct.
Then it goes to the airline operator. Say it comes to India to an Indigo. Then it is also, there is an MRO facility, which is a maintenance, repair and overall facility. So whenever there is repair to be done, the engine will go there. And then it has to be returned to the aircraft, airline operator.
Right.
All these stages require, during transportation, loading, unloading, testing, fixing, they will require the stand.
Understood.
So this stand is bought by multiple parties, and the stand becomes critical for all of these engine operations.
Understood.
And the stand is what these guys will sell.
Okay.
And this is one of the 3,000 parts that they sell.
Right.
So stand is just an example, but it can be something else also. In a nuclear reactor, for example, they are able to make plugs for fuel coming in and out.
Understood.
So they're making very mission critical parts, or they're making parts which enable something for the entire ecosystem. So that's the kind of complexity.
Right,
And
right.
these are not very simple, right? Because these stands also weigh like 2,500 kgs.
Correct.
They're the size of a small car. They have shock absorbers. They have corrosion-free equipment, sort of material and stuff like that.
Right.
They have valves for unloading, loading, freight-friendly, forklift-friendly, blah, blah. So it's very complex.
Correct,
It's not like a IKEA stand. We're not talking about very simple stuff.
No, so, okay. So, I mean, it sort of makes sense what they do. And I understand their products are complicated enough that none of us are going to completely understand what they do, right? But I think we've all sort of established the space they're operating in, the kind of products they're building, right? But what's working from 7x growth in 3 years is not normal.
Yeah.
Especially when you're dealing with highly customized, specialized products and low volumes. So it's not like the demand suddenly increased and now the company is on a absolute whatever uptick, right?
Yeah.
So what's working for them suddenly for them to achieve this level of growth?
So I think they're very highly focused on engineering capability. They're not in a business which is high volume.
Correct.
So there are some common points across their products which stand out in terms of what is working for them. One is the fact that they're in a high mix, low volume business. Number two, they're in a business which requires extreme precision. So imagine even if the stand were slightly a few microns tilted, it's going to give you wrong results.
Right.
That's going to cost lives.
Correct.
So they require high amount of precision, which they're nailing very well. They're in businesses which have long qualification cycles. So Airbus or Boeing are not just going to come tomorrow and say, okay, you look good, you've grown so much, contract signed. Here,
correct.
Take the contract.
Right.
They go through a long qualification cycle where they have to actually deliver something that goes through inspection. Then they come back.
I'm assuming there's a bunch of licenses, etc. involved.
So there is, that's all. The fourth point was that there is a very high barrier to entry. So they've carved out a space where they're good at, and then which also takes very long for competition to enter.
Right.
So then they're able to sort of be rulers in their space. So high barriers to entry can be because of the machinery required.
Right.
Because the machine that they're making itself is complex, so they require complex machinery to make complex machinery. So the workforce has to be highly specialized.
Right.
The quality standards have to be met, which are again very, very stringent.
Right.
And of course, certifications have to be obtained because aerospace as an industry itself or defense as an industry requires a lot of quality certifications to be in place. So that being in that space and bringing in that technical expertise is what has worked beautifully for them.
So, okay, so what way is essentially, so makes sense.
And additionally, the fact that once you get into a Boeing, Airbus, Collins, Mitsubishi, etc., these are hard customers to get.
Right. And now they are trusting you. So, unless you absolutely screw things up, you're going to have these contracts extended.
Contracts extended. And then if you're focusing on multiple SKUs, you delivered one stand, for example, right? You found it extremely good, useful. You've entered the customer, you've broken through. There are multiple things to sell.
Correct.
One single aircraft has millions of parts.
Right.
These guys can get somewhere through higher SKUs as well.
Right.
So if they show capability of producing something well, more manufacturing work will come their way eventually.
Correct. Okay, so what we're essentially establishing is there's a bunch of reasons they're doing well. They've built this sort of moat or whatever else you want to call it, right? High barrier to entry, etc. That's working for them. Tariffs have gone against them, which is happened in the last few months, right? And that sort of caused the stock to go down a little bit. But overall, the company is set for growth.
Yeah, I mean, see, they've delivered exceptional growth in the past, right? They've sort of grown 7x in the last 3 years, which is more than an 80% CAGR. If they're aiming for 1,000 crore revenue by FY29, they're set to grow at a 45% CAGR in the next 3 years.
Right.
This year has been a blip where revenue, what they're saying is they started the year by saying that they'll achieve a 40% growth in this year.
Correct.
However, the way the year has gone, now they've revised their guidance downwards and they're saying that, we'll probably achieve the same level or a little more compared to last year, which is going to be flattish revenue. So overall, from a capability standpoint, they look great because of 3 reasons. One is aerospace, and maybe we can tackle this like vertical wise.
Right.
So aerospace, they have a long leeway for growth.
Correct.
Because their wallet share within customers will be very little at this point in time.
And it's only going to increase with time, assuming they provide the right whatever. They do their job well.
Yeah. So if they increase the number of SKUs, if they increase the wallet share, and if they target some new customers that they probably don't have, they're bound to do well.
Correct.
Especially because the entire aircraft manufacturing cycle also is one which has a high visibility of growth. So typically what happens in this cycle is that, there are only two main manufacturers, Boeing and Airbus. And then there are only a bunch of engine manufacturers, but there are multiple component manufacturers. When Airbus and Boeing, so basically they determine how the entire cycle of the industry will work. So typically what happens is there is a design cycle of 5 to 10 years where they design the new plane, etc. But it's not just a design.
I understand. It's prototypes, etc. All of that. Right?
So after that, there is a production ramp up because they'll start taking orders for the new aircraft. Production ramp up happens over 3 to 5 years. Then they reach steady state production, which lasts for a good 15 to 30 years.
Okay.
So you don't see new aircraft models coming in.
It's not like cars.
New E-classes out within 3 years, right? New S-class in 5 years.
Right.
These are 30, 35 year cycles.
Correct.
And then there is a phase out cycle. So currently you're seeing the previous generation of aircrafts being phased out.
So one second, simple question here. All your aircraft buyers, right? So let's say you've got in India, you've got an Indigo, Air India, etc. And across the world, you'll have multiple such airlines. They are all sort of placing the orders around the same time?
Not really. They're placing orders for the same aircrafts.
Correct. But the production cycle is determined. Production is happening over a certain number of years, right?
Yeah.
So they're all sort of...
Right now, there's a large backlog. So basically, they've taken orders at these air shows and blah, blah. And also, I mean, it'll depend on which industry is growing where. Right now, majority of the orders are coming from India and APAC.
Right.
And Middle East or whatever. Asia is dominating the air buying industry at this point in time. But that's just a function of India's growth and China's growth and whatever at this point. But again, so buying will happen. You're right. Though. Buying will happen at a certain time. Orders will get fulfilled over a period of time.
Right.
Like Indigo's, for example, ordering 200 aircrafts.
Correct.
But they'll get fulfilled over a period of time. So they're also forecasting and predicting in terms of what they're buying.
So what you're essentially saying is that because if Indigo places an order for 200 aircrafts today, right? Those aircrafts will be delivered over the next 10 years, maybe 15 years and longer, right? And obviously the payment cycles, everything. So essentially when a Unimech today is looking at the industry, they already have visibility of what's happening in the next 15 years.
The orders will keep flowing in. So they have visibility of the current model being in production for the next 15 years.
Understood.
And because the industry's order book is at say 16,000, 17,000 aircrafts, but they're delivering only say for example 75 per month.
Understood.
You can't mass produce aircraft.
Correct. Yeah, of course.
So if the airline industry order book is at a certain level, but the monthly production rate is much lower, you have visibility that for the next 15 years, contracts are going to continue flowing in. And every time an engine is produced, it needs transportation, it needs fixing, it needs repair, it needs transport again.
Right.
So those stands, for example, are going to come off use.
Correct.
Similarly, some part which is a part of an engine will be manufactured so many X number of times. So here, and then whatever. So right now, I think the Airbus and the Boeing planes, the new ones, they're sort of in that production ramp up stage. So you know that for the next 15 years, the demand will continue. And then by 2035, these guys plan to sort of say that, okay, Boeing and Airbus will start planning new aircrafts.
Right.
So again, that cycle will repeat. So, sorry. So one factor was...
Yeah, I know. We drifted.
So aerospace demand is bound to sort of be high for the next few years. That is a given. And second is the formula that we spoke about in terms of what is working for them. They're applying the same formula into new industries like nuclear and semiconductor as well.
Right.
Both of these industries are pretty sunrise-ish in India at this point in time and have a long leeway.
Correct.
So they're not just making the right products, but they're making them in the right industries as well.
Which are set for growth and there's no telling how big that it can get.
Yeah. So from 1,000 crore standpoint, with a base being low, the company having done well so far, there seems to be fair confidence in terms of saying that these guys can achieve it. If not 2029, maybe 2030, but looking at
they're on the right trajectory.
Yeah.
And so, okay, now again, on a slight aside, right? Obviously, nobody knows what's going to happen in geopolitics, etc. But how temporary or how big a hit are these tariffs to them? Because that's essentially what's caused their stock to half.
See, US is about 30% of their revenue. So that is a direct impact. 30% of revenue is impacted because, and not in terms of 30% of business evaporating. Whatever orders they've got, they're placing and whatever. Softer aspects like delayed decision making, lower inventory, higher inventory on their end, higher working capital engagement on their end.
So all of that sort of marginally costs them at some level or the other.
Yeah. And what also happens is, while the direct impact or direct US exposure is 30%, there is an indirect exposure to the US as well. So what will also happen is that because these supply chains are very complex in aircraft manufacturing, you may send a product to, say, for example, Europe. It gets assembled in Europe, and one part gets assembled in Europe, which is then further shipped to US for more assembly.
Right.
So that route will also have a US dependence as such. So it's not really direct US dependence, but there is an indirect US dependence as well.
Correct.
So in effect, while it is 30%, the impact could be much more. The other thing that has happened, especially to their stock and their financials, is that it's not only the impact of the US tariffs, but because they're entering new spaces, especially nuclear and semiconductor, they're also sort of in a phase where they're in an investment zone in a lot of these places.
Right. So they're losing money for now, not losing, but they're putting in a lot of money to build these verticals.
So, say for example, I mean, currently read somewhere that there are about 100 of their products which are going through something known as a first article inspection, where you present a prototype or a product. The buyer or the potential buyer will review it, inspect it, run tests, etc., come back with recommendations, approval process basically, and which also takes a few months to go through. So when you are actually in that phase, you are still building your infra, you are making the product, you are giving it further. There is no revenue coming in.
There's no sales happening essentially.
But there is a very high front-loaded cost to it. So they are in that investment zone when it comes to a couple of these industries altogether, where they're making investments, and tariffs hit right at that time. So they're sort of they're in a double whammy situation, where if the tariffs hadn't hit, they would have done fairly better.
Correct.
So what has effectively happened is that their EBITDA margins have gone, say, from 38% to 30%. Because suddenly operating leverage has dried up. High cost is front loaded. Their capacity utilization has grown from 93% 2 years back to 55% now. Because they've also added capacity. They've aggressively added capacity, but the orders dried up. Or there is a gestation period. So all of these have resulted in not only the revenue remaining flat, but the margins taking a hit, the return ratios taking a hit, balance sheet looking bad, working capital being stuck, cash conversion cycle being long, and hence the stock suddenly looks bad because you're like, hey, you know what, these financials are not healthy financials. However, one's got to understand that this is a temporary phase,
and it's also a phase, I'm assuming, where the business is going from one stage in the life cycle to another. So it's sort of stepping up, and which is going to have a small sort of plateau before it again goes up, right? That's what one would assume.
So even in nuclear, these guys, for example, have applied for bids which are in total worth about 800 crore. Now, 800 crore worth of bids, even if they're able to win, say, 200 crore or 300 crore, 200 crore is still like a 20% of their total revenue right now. No, sorry, 20% of
their goal.
Their goal. So in terms of where they are and what they're building, I think they're doing the right things in terms of building blocks. It just takes a little bit. I think it's just a temporary blip where one is an external factor and the second is an internal factor of investments, which have unfortunately both converged into this one period of time and resulted in this stress for the company.
But I read today that there's some free trade deal that's happened today on the day of recording between India and the EU. And I don't know the details of it, but it's supposed to be the mother of all deals, and there's about 200 billion at stake. So I'm assuming companies like this that also have customers, clients, etc. in across the EU, right? With the Rolls-Royce, etc., they only stand to benefit from this, right?
Yeah, I mean, see, at the end of it, the way the trade deal has worked is when there is a standoff between two nations and the trade tariffs are not moving lower. India has found a way where India's shipments to the US have been impacted. They're down by some 10%. But India has found other partners to trade with.
Right.
Our trade with China is at the highest ever. We're trading with Southeast Asia. We're now striking deals with UK was signed.
Right.
EU is signed. Saudi Arabia was signed.
Right.
So we're striking other deals. And the same thing is happening in China as well, where because there is a US exposure and that has gone down, China is also diversifying across Latin America and Southeast Asia,
Correct.
So the world is able to sort of rejig itself. Obviously, there's going to be at a country level and macro level, you're seeing that numbers are flat for India. The export numbers are currently sort of the import numbers have not really
export numbers only, no?
Anyway, trade numbers haven't changed much. With China, in fact, they've hit the largest trade surplus ever despite this situation.
Understood.
So they've actually done better despite this stress. But obviously, there are at a micro level companies that get hit. Like Unimech has gotten hit.
Right.
It would have grown by 40%, but it's growing by a very unglamorous 4% right now.
Correct.
So that's not really working out.
So the $1 million, or not the $1 million, the 1,000 crore question is, how would you value Unimech?
See, the point of investing is to grab up good businesses, but also grab them at a good price.
Correct.
I think I've sort of fairly established through research that this is a great company, and they've sort of proven that in the past as well.
Right.
The steps they're taking ensure that even for the future, they're sort of built in the right direction. So no doubt that it's a greght company. Price, it's already sort of gone from 1485 at listing, which was in December 24, to 825 as we speak.
Right.
So that's a steep correction. But also there has been a reset in expectations, right? Because growth didn't really come.
Right.
We were expecting 40% growth, but 0% growth came.
Right.
And the stock corrected 40%. So there is a proportionate sort of adjustment in the price. However, if I have to just very simply say that, okay, one is to establish that whatever has happened is a temporary blip. Convergence of factors, which is very unfortunate in terms of timing.
Right.
Doesn't change anything fundamentally.
Correct.
Except for timing, which is basically shifting your Excel row column 1 for analysts. I'm sure the business is struggling way harder than shifting one column ahead. But if I have to very simply look at the company, if they have to achieve 1,000 crore revenue, if not in 2029, say in 2030.
Correct.
Okay. If it has to be 1,000 crore revenue, assume an EBITDA margin of 30%. They've done 38 in the past, but assume 30 happens. They get 300 crore in EBITDA.
Right.
Net profit margin has been about 25%. Assume that comes in. 250 crores is the PAT. If the company is growing at a 40-45% CAGR and you give it a PEG ratio, PEG is price to earnings by growth.
Okay.
Company is growing at 45%, you give it a 45 times multiple.
Okay.
If you do that, the valuation
on 250 crores.
Yeah. The market cap should come to about 11,250 crore.
Okay.
What is it at right now? 4,300 crore.
Right. So it's almost, you're saying you're looking at a triple.
Yeah, but
in the next 3 years, 4 years.
Then I should have the patience of holding on till like 2029 or 2030. So if I have the patience of holding on to 4 years, and if these guys are able to achieve that growth rate and that quantum, then they can reach, obviously they'll multiply in value as well.
Correct. Sounds good. So you're saying it's great without saying it's great.
Great company. Okay, let's leave it there.
I think what essentially you're establishing here is the fact that even though the stock went down and the growth rate went down, it had nothing to do with them screwing up as a company. And I'm saying this in very layman common language,
of course.
where they haven't done anything wrong.
Yeah.
So it's only external factors which
and
can
bad
happen.
Timing.
Bad timing.
Sure.
Cool. Fair enough. So Unimech, please do your research before buying any stocks. And that's all for this week. Thank you so much for listening. Please like, share, subscribe. Let us know what stocks you'd like us to cover in the future episodes. Thank you.
Disclaimer. This content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.